everybody. This is Mike Preston at New Harbor Financial Group. It is Thursday, August 17th, 2023. We just wanted to provide you with a quick update of what's going on this week. What are the hot topics and some things that we're getting a lot of questions on. So we thought we would just try to respond to those here, be a little bit easier to communicate with a lot of our clients here in one forum. Of course, you're always welcome to give us a call. We're always happy to talk with you. We're getting a lot of questions on interest rates right now. Interest rates have gone up precipitously. They started going up in March of 2022. So it's almost a year and a half now since the Fed has started raising rates off the zero bound. We were stuck at zero or close to zero for close to 10 years. And this was in the aftermath of the great financial crisis of 2008, 2009. Federal Reserve dropped rates down near zero and left them there for almost a decade. Most central banks followed suit. They all followed what the Fed did. And I think that what they did is created the largest bubble we'll ever see in our lives, a bubble in everything. Many people have called it the everything bubble. We saw stock markets go up, real estate go up, collectibles went way up, a whole bunch of different esoteric things came to market like meme stocks, NFTs, which are, basically digital artwork. There was a whole Bitcoin and cryptocurrency that came to pass. And so we've lived through this time and we don't know what's real and what isn't real. What we do know is real is math, and valuations have been completely off the charts. They remain there. They're unlikely to remain there over the duration of this market cycle. We're seeing a lot of things in the market now that are telling us to be cautious. And I know that some of you will probably say we've been saying that a long time. It's true. We'll be the first to admit that this bubble has lasted a lot longer than any of us thought was possible. It's been a really humbling experience, to say the least, to watch this market refuse to go down, and that with each misstep, each small pullback, central banks have come in and printed more money. We saw the largest blow off top I think we'll ever see after the COVID crisis in March, or I guess it was February and March of 2020. The market fell 32% in 17 days. Our strategy was actually flat to up during that time, but the broad market came roaring back so fast with $7 trillion of new printed money after COVID. It surprised even us. And here we are still in August of 2023. The market is not too far off its all-time highs, but at the same time, we're about 16, almost 18 months past the market peak. The S&P 500 topped on January 4th, 2022, and we have been on a straight up bounce since October of 22. But here we are still with bullishness back at all-time highs, valuations at all-time highs, and a market that's acting badly. And when I say acting badly, it's because there's a very narrow range of stocks that have been driving this market higher. It's like 7 or 8 stocks. And if you're not in those, you're quote unquote being left out. So let me just share some charts here so we can take a look at some things about interest rates that I mentioned. So here's the US Treasury 10-year yield going back about 40 years, a little bit longer than that, actually. So in the 1970s, interest rates started going up. This was the age of inflation, and finally got into the high teens. Money markets got even higher, if I recall, got close to 18%, but the 10-year bond was trading at around 16%, and nobody wanted them. And so in came Paul Volcker, the new Federal Reserve chairman. He said he was going to break the back of inflation. Eventually, his policies did break the back of inflation. And what it really launched was a 40-year bond bull market, or a period of time of 40 years where yields went down. And so this was a huge tailwind at the back of the financial markets over the last 40 years. Financing got cheaper, investment got cheaper, mergers and acquisitions got cheaper. And as we entered the 90s, it kind of plateaued. And many of you might remember that Alan Greenspan at the time, it started to encourage home equity lines of credit. In my opinion, the Fed exacerbated the tech bubble by encouraging Americans to start tapping the equity in their homes. And this interest rate here stagnated in the 5 to 6 range for the 10 years from 1992 to 2000 or so. And yes, it caused a large blow off top, I believe, in technology stocks. And that crash from 2000 to 2002 was rescued by further reduction in interest rates. Greenspan pushed rates down further. His successor, Ben Bernanke, really pushed rates down further, down to below 3% in 2003, 2004. I believe that's what exacerbated the housing bubble. The housing bubble burst caused the great financial crisis of 2008, 2009, and then we went directly into ZIRP, or zero interest rate policy. Very quickly, post-financial crisis, $16 trillion in new money was created by central banks. That number has been far surpassed by now, but in the early years of that response, 16 trillion of new money was injected into the system, and rates went to zero or near zero and stayed there for 10 years. In some parts of the world, rates went below zero. And at one point, we had more than $18 trillion of government bonds trading in negative territory. So this was unprecedented. Nobody knew how long it was going to go on. We certainly didn't know how long it was going to go on. And we've been saying for many years that we think that this is unsustainable. At the same time, equity valuations reach levels not seen since 1929 and at the tech bubble peak in the year 2000. Early last year, in March of 2022, rates started rising. And you can see that we went from about zero to where we are today on the 10-year yield above 4% actually as we speak. So it's been a very sharp move, really one of the fastest up moves in history. You'd have to go back to 1978 to 80 to see a faster vertical move of that magnitude. And that has yet to make its way into the financial system. There's often a lag. There's a lag of 14, 16, 18 months once interest rates start rising to when you see it in markets. I believe we're starting to see that now. Take a look at what it's done to mortgages. This chart goes back about 20 years, and it shows that mortgages, which have been around 3% or so for 10 or 15 years, have now shot above 7%. And this is while the housing market has barely budged. The housing market in some really hot spots has come off maybe 10% or so, maybe a little bit more in some bubble markets. But by and large, in most markets, housing prices are only down a few percent off the bubble highs of 2021. I believe housing markets will drop. Probably the stock market drops first. The housing market will probably follow a few months later. So let's take a look at a couple of our positions. I know a lot of you are concerned about a couple of our positions. Let me first say that we're very lightly exposed to the stock market here, only about 5% net exposure, because we have exposure to emerging markets in various different countries, but it's more than offset by short, non-leveraged short positions that take away most of that market risk. But we are about 5% net long if you don't include gold mining stocks. If you do, it's more about 15%, but we're extremely lightly exposed, and because we think this market has downside crash risk, and we have about a third of accounts in short-term treasuries and cash equivalents so that we can take advantage of any opportunities that come in declines. So TLT is a position that we hold to the tune of about 15%. It's a little less than that because of the decline in the stock price, but the target is about 15%. And what I want everybody to know is that we don't have 15% in accounts anymore for most of you. If you have more than a couple hundred shares of TLT, this is definitely true. A month or so ago, when we started to see a breakdown, we put a caller on TLT. We sold calls up at $106 per share. That brings money into the account. And then we bought October puts down at 98. Well, what a put does is it puts a floor in the stock and says that you're guaranteed not to lose any time below or any more below that line. So let's say you had 1,000 shares of TLT, we would have sold 5 call options up at 106, bought 5 put options down at 98. And since this stock is trading down below 94 at the moment, essentially we sold or we sold mathematically half the position up at 98. Okay, technically we have a put option at 98, which gives us the right to sell that stock out at the third Friday in October at $98 a share. Now, it's not guaranteed that we will sell it there. We have the right to sell it there. We'll see what happens. If we get a big vertical move, it's possible that we don't sell it at 98. But the key point here is that positions have been reduced from about 15% down to roughly 7 or 7.5% in TLT. Furthermore, we did sell a call option on the other half of TLT up at 98, and the last round brought in about $1.40 a share. That option expires tomorrow, and we may very well resell options on that other half in the beginning of next week. So bottom line is, mathematically, we're out of half the position, and the other half we're bringing in income without by selling calls. It's still a painful position, I know, but what I want you to know is we're managing it. The exposure has been reduced, and the options tools that we have will allow us, in my opinion, to ride out what I think is a second capitulatory move, the first one being last fall. I still think that when this market falls, the S&P that is, that there will be a rush into safe havens, and that we're very likely to see a recession and or deflationary scare when that happens. And I believe that TLT will go much higher. There's no guarantees, but that's why we're managing it with the hedges. Gold is a chart that looks great. Now, the gold miners are underperforming gold, but real yields have been increasing. That's because inflation has been coming down. And as we talked about a minute ago, the 10-year treasuries are above 4%. So the real yields, or that is the return after inflation, have been increasing. Normally, in real positive yield environments, gold doesn't do as well. But gold has been holding up. Look, take a look at a chart of the monthly chart of gold. This is a 20-year chart. Over the last couple of years, gold has been forming this triple top, presently trading a little below $19.50 an ounce in the futures market. I believe that we're going to get a surprise move higher, whether it's an inflation scare or a geopolitical event. I don't know. But I believe that gold will break out above $2,000 and $2,100 an ounce and then move higher. The target from a technical perspective would be around 2,500. I think that gold could actually go much higher. I don't know what the catalyst will be. One thing I might mention is that there's a big meeting next week in Johannesburg, South Africa. The leaders of the BRICS nation are going to meet August 22nd to August 24th. And what they're going to talk about at this summit is a new currency or a new trade currency so that they can trade amongst themselves in an easier fashion. The dollar has enjoyed fantastic privilege being the world's reserve currency for so long. And frankly, it seems like some of the BRICS nations are kind of sick of that situation, particularly after the dollar has been weaponized. And, we said that you can't use the SWIFT money transfer system anymore. We're going to freeze interest payments on treasuries, that sort of thing, particularly against Russia. The sanctions against Russia have likely motivated these players to come up with an alternative system. So they're meeting next week in Johannesburg. I think there's 9 members that want to be part of this new trade currency, and that includes Saudi Arabia. And there's a whole bunch of others on the waiting list. If they create this currency, going forward, it'll probably be backed by gold, and then these countries can then trade commodities amongst themselves, and then they can receive BRICS notes for it. I don't think there's going to be actual paper notes, and they still have to build a bond market where one can park savings from these trades. For instance, if Saudi Arabia sells a bunch of oil and they receive $100 million in BRICS currency, whatever that currency looks like, they have to park it somewhere. They can't just sell it back to their own currency. That has ramifications in the currency exchange market. What they're likely to do is park those savings in some type of bonds. And so we don't know what those bonds will look like, these BRICS bonds, and whether they'll sell them to citizens of those BRICS nations or what they'll do. But this is a pretty significant event. It's not going to mean the death of the dollar overnight. If the dollar does decline over a long period of time, and we think it probably will, it's going to take years. And frankly, the dollar will probably even get stronger in the very near term if we have an economic crisis. So, but this is only one link in the chain. And if we see an acceleration of this or a widespread adoption, it will almost certainly be negative for the dollar long term. Why am I saying all of these things? Because I think it's supportive. It's one of many things that are supportive of gold. So we still like gold here. We've got a 10% exposure to gold mining stocks. We have half of those hedged with put options as well. We'd encourage people to take a look at their exposure to gold and silver bullion. We recommend that you hold 5 to 10% of your investable net worth in bullion in your own hands if you can. Give us a call if you want to talk about that, talk about how to do it, what our recommendations are. I think that's enough for this week. We try to keep these short, 10 to 15 minutes or so. We'll be back next week with more updates. And for now, thanks for watching. Thank you for your continued trust and patience with what has been a very difficult market. Thank you very much. See you soon.